Welcome to the weekly update, where I'll go over the action in the market for Tuesday, February 21st through Friday, February 23rd, and then we'll see how things look for the week of February 27th through March 3rd. We had a down week. Some of our charts are starting to show some weakness. We're looking more negative on the daily charts, and that's also bleeding over into a trendless environment. With the ADX on the daily charts, we're also starting to see that in the weekly charts as the market tries to figure out, does it really want to go lower from here? Does it want to go higher? There was a real shift in scenarios this past week. It's actually been building the last couple of weeks. Ever since we had that really high employment report, the market has been really unsure about this idea that the Fed will be able to pivot and start to lower interest rates. That seems to really be in jeopardy right now, and I'll talk more about that as we go through the video. Let's go back and talk about this week's session. Stocks on a general basis were pressured by the sense that the market is due for consolidation. We had a really big run up since the beginning of the year, and so a pullback was due. It kind of overdid it on one hand because the Dow has given back all of its gains and it's actually down on the year now. Interest rates are up, the dollar rebounded, and there's this new scenario that has been developed over the past few weeks that the Fed is likely to keep rates higher than expected for longer than expected. And the markets don't really like that. We're seeing this in the general trend of the economic reports, and this has helped to support the Fed's hawkish stance. We had the employment report, which was stronger than expected, the ISM services PMI, the CPI, the PPI, those came in all stronger than expected. Well, this week we kind of fed into that. We saw a stronger than expected core PCI price index, and this is what the Fed really likes to use to measure inflation. Going back to what happened on Tuesday, we had a broad retreat amidst rising market rates because the interest rates were going up, and there's some increasing geopolitical tensions, and I'll talk about that in just a moment. By Tuesday's close, the Dow had given back all of its 2023 gains. The S&P was just a little bit under 4,000. There was a report in the Wall Street Journal that China's President Xi will likely head to Moscow in either April or May to meet with Putin and encourage peace talks. That's the nice side of what we're hearing. There's another report put out by the New York Times that said China is considering providing lethal assistance to Russia. That's the negative side of things. Also, Putin came out and announced that Russia will suspend its participation in the New START nuclear treaty. That's being taken as negative because the idea behind that was to have more control over nuclear weapons. Then on Wednesday, we had the FOMC meeting minutes released. They came out at 2 p.m. Eastern Time. The main quote that they're taking from that is it says that substantially more evidence of progress across a broader range of prices would be required to be confident that inflation was on a sustained downtrend path. There were some people in that meeting that wanted a 50 basis point hike. And other than that, there wasn't anything all that surprising in the minutes that came out. And this led to the stock market going down slowly. Then on Thursday, we finally had an up day after 4 down days. The S&P had fallen below the 4,000 level and the 50-period moving average. And then buyers came in and pushed prices back up. The report that we had that day was that the fourth quarter GDP, it supported the idea that the Fed might want to continue raising rates. On Friday, we had a broad-based decline following a hotter than expected report that came out with the PCE core index that I referred to a moment ago. The report, taken as a whole, showed more inflation rather than disinflation. And then St. Louis Fed President Byrd came out, who's not a voter, said that it appears that the Fed may be able to disinflate in an orderly manner and achieve a relatively soft landing. The S&P on Friday got down almost to its 200-day moving average at 39.40. So for the week, the Dow was down 2.67% on below average volume. We're seeing that across the board. Daily charts, now weekly charts. The technicals, they're positive, but switching back to being more negative. Where on the daily charts, we are back to negative because of this inflation and interest rate scenario, which are producing growth concerns, not only in the U.S., but outside of the U.S. Our trend is still weakening. We've dropped below 20 with the ADX. We've also dropped below 20 on the daily chart. It's still positive on the weekly chart, but we've turned over to negative on the daily chart. Here's the intraday action showing from Tuesday how we gapped lower and then just spent the rest of the day going down. We actually went all the way down to S3. Then on Wednesday, we tried to go up a little bit at the open, came back down, went all the way up to this daily pivot. We hit resistance. Right in here where you see this kind of psychotic bar, that's when the Fed minutes were released. And then we ended up spending the rest of the day going down. On Thursday, we gapped higher, only to come back down below the daily pivot. We came all the way down to this pivot level before staging a pretty nice comeback and closing not too far off of the highs. Then on Friday, we gapped lower and pretty much chopped sideways. We went all the way down to S2, tried to get back up to S1. That wasn't happening. Came back down and closed just below S1. For the week, the Dow was down 3%, the Nasdaq down 3.3%, the S&P down 2.7%, and the small caps were down 2.9%. This is how it looks over the last 4 trading days, Tuesday through Friday. Small caps were the only index that was up, where all the other indexes were down for the 4 trading days. Going back to the beginning of the year, the Nasdaq and the Nasdaq 100 are still doing the best, but they're giving back a lot of their gains. The Dow over on the right-hand side has now gone negative on the year. Going back to the all-time high, all of the indexes are still underwater, led by the Nasdaq and Nasdaq 100. Even though they were making a good attempt to recoup these losses, they're starting to give some of that back. The sectors, all of them were down on the week except for energy, and it was just barely up. The areas that had been performing better in 2023 really got hit, like discretionary, communication, real estate, utilities, tech, and then at the very bottom you see where energy was up just slightly on the week. And again, that's just the 4 trading days. This is how all the different sectors performed from Tuesday to Friday, with materials and energy doing the best, followed by financials, and all of the other sectors were down, led by real estate going lower. This is going back to the beginning of the year, where discretionary, communication, and tech, these are the growth areas. They're still positive on the year, but they're giving a lot of those gains back. Where we have the areas that were strong in 2022, staples, energy, healthcare, utilities, they continue to be negative going back to the beginning of the year. Then going back to the all-time high, energy is in the lead, and all of the other sectors have had declines. Sentiment is down at 59. We had been at 62 from Thursday to Friday. We're still in the positive area, but we're coming down with our readings, as shown here in the next chart. We got above 75, and now we're working our way back lower. We also received the final reading for consumer sentiment. That's the blue line. It's recovering from being down at 50, but it's still at not a very good level. When you compare that to the 2-year Treasury yield, we still have a really wide spread between the two. These have a tendency to go in the same direction, and even though they're on different scales, they have a tendency not to get that far apart from each other. They're going in opposite directions, and they continue to be far apart. The VIX ticked up a little bit on the line chart. That's the closing value, as well as on the bar chart, and not necessarily a surprise with the down week. The active asset managers, after giving us an extreme positive reading, have now fallen back, and they're giving us a more neutral reading at 57. The Ridex bear-bull ratio, not really showing anything too extreme in the bearish funds, not showing anything too extreme in the bullish funds, kind of in the midpoint. The latest reading of the American Association of Individual Investors show that it's above 0 and advancing. Now, this is a week old. It's probably going to drop in the next survey because they'll react to what happened in the market. The Ultra Index continues to be below its moving average. We're seeing it start to move up on the daily chart. It hasn't really moved up yet here on the weekly chart. The spread between the risky loans and not as risky loans still show that we're going down overall. If we were really starting to spike up, that would give us more concern economically. And the National Financial Conditions Index still shows that we're going down. If we were to get back above this black line and go higher, that means we're running into trouble. The fact that we're declining just kind of goes contradictory to some of the other economic reports that we've been seeing. This report I showed last week, this shows the percentage of domestic banks tightening standards for both commercial and industrial loans. This chart has not been updated You can see over here, the last time I had the most recent update was February 6th. I went and checked the chart again. There was not an updated version. We just want to keep an eye on this. Banks are starting to tighten their lending standards, and that could really go through the economy. Looking at the latest reading of the inflation nowcasting, where we saw a real spike up with the PCE inflation as well as the core inflation. There's a 73% chance that we'll be at 4.75% to 5%. But over on the right-hand side, we're starting to see this grow a little bit. There's now 27% of market participants that think we could go 50 basis points at that meeting. The Fed continues to lessen its balance sheet as it does quantitative tapering. Looking at breadth, we're still above the moving average based on price and volume, but we are seeing this go down. We're still above the zero line with our advanced decline ratio, but it is declining. We didn't see much of a breakout in new highs, new lows this week, so we're declining with our 4-period moving average and we're declining with our 10-period moving average. Accumulation distribution is still positive. It's above the moving average, but it did decline. Our trend shows that the ADX, that's the black line, has dropped below 20 and it's below the moving average. So this is a weakening trend. The green line is still on top. In this past week, we saw a cross in the daily chart. We're waiting to see if we'll see that cross in the weekly chart. Our rune showed that buyers really picked back up and sellers really decreased, so that improved the overall oscillator. No signal is being generated right now with the mass index. Looking at the daily chart, we came down and broke through this upward sloping trend line, which had been giving us some support recently. We also came down to the 50-period moving average and then dropped all the way down to the red line, which is the 200-period moving average. If we continue to fall below the 200-period moving average, we're going to bump right into this trend line. Will that act as support if we hit it, or are we going to break right through it? We'll be watching that closely to see how price reacts. The trend channel shows that we're right about in the midpoint of our trend channel going back to 2009. We dropped below the monthly pivot on the weekly chart. That's more negative. And you can see at the bottom where volume has really dropped off. We're starting to come back down to this 50-period moving average, which equates to a 200-day moving average. The long-term trend getting really close to a golden cross, but now we're seeing some weakness. And so this 13-period moving average is starting to roll over. The bullish percent index, after giving us an extreme positive reading, is coming back down, and we dropped slightly below 50. So that's negative. The Chaikin oscillator continues to decline, although we're still above this dashed zero line. The Chaikin money flow still shows that we are advancing. So that's positive. The force index is getting ready to drop below the zero line. Clone oscillator starting to get extreme negative, so we're negative overall, but this still has room to go down if it desires to do so. The summation index based on price and volume are declining, but we're still above zero with both. We're positive but declining. The slope is crossed over negative, but none of the other oscillators have done that yet. We're seeing some rollover with the TSI, the MACD, the PMO, the PPO, the TRIX, and the KST, where on the daily chart, all of our oscillators have switched over to negative. The swollen trading oscillator based on price and volume are negative and declining. The PMO study shows that the PMO is still in an uptrend, but we're starting to drop below zero based on price. We haven't quite dropped below zero yet based on volume. Looking at our PMO studies, the PMOs that are rising are starting to get extreme negative, as are the number of buy signals, and we're declining with the PMOs that are above zero. And we're seeing a very similar chart with our daily version of this. The relative strength index is starting to drop below 50, so that is negative and declining. The special K continues to be positive as long as we're above this red line. The Stochk RSI is declining, and the Williams percent R also is declining. The vortex is still positive, but the green line's coming down and the red line's coming up quickly. The ultimate oscillator, it's still positive, but declining. We're above 50. The money flow indicator is actually a little bit positive, but it's still below 50. The Bollinger Bands, looking at the percent B index, shows that it is declining, but we're still above this dashed line. The rate of change going back 1 week showed that we did decline. Going back 50 weeks, we're trying to bounce up after getting an extreme negative reading. The cockpit curve, after giving us a buy signal, has now crossed over, so that signal has gone away. The weekly chart, looking at our fib levels, we're still above this red moving average. That could be acting as support. If we continue to fall, we might go down to this 38.2% retracement level at 38.12. Our different charts with the Heiken Ashi with a dark candle, that is negative. The Kegi is still positive with a black line. The Renko is still positive with open boxes. The ease of movement shows how we had to decline looking back 1 week, and we're showing weakness going back 14 weeks. We added some new zeros on the point and figure chart, but nothing has been triggered yet as far as a signal. The 3-line break is still looking positive with open bars. The Elder Impulse system for the S&P weekly chart has now switched to negative. The dots are still below in the parabolic SAR, so that's positive. But if we see more weakness, it would not be surprising to see the next dot come in on top. Looking at the S&P, the mid caps and the small caps, not really seeing anything too divergent currently. All stocks, after giving us a recent golden cross, have now been showing weakness. The mid caps also, recent golden cross, showing some weakness. Small caps, recent golden cross, showing some weakness. Broken record here. The Dow, recent golden cross, weakness. It's back down to its 50-period moving average on this chart. The weekly chart of the NASDAQ did not generate a golden cross, but it looked like things were getting a lot better, but now we're seeing some weakness. And the same thing is true with the NASDAQ 100. The Wilshire, it had been getting close to giving us a golden cross, but recent weakness might make that in jeopardy. The NYSE did give us a recent golden cross, but now is showing some weakness. The FANG stocks getting close to a golden cross. We did see a golden cross on the daily chart. We're not seeing it yet on the weekly chart. ARK, long way from any kind of a golden cross and still continues to be in a downtrend. The biggest software companies, they were looking much better, but now showing some weakness. The Dow, the transports, and the utilities, not really seeing anything all that outrageous as far as Dow theory is concerned. Looking at the broad markets, the CRB index continues to be in a downtrend. Copper is still in an overall uptrend, even though it gave back some gains this past week. Gold, after giving us a golden cross, it seems like with gold, the second we got this golden cross, that's when a weakness started to come in. And the same thing is true with silver. Was looking a lot better, but now giving back those gains. Oil, it's been pretty much chopping sideways, anywhere from 80 to the low 70s. The dollar has been bouncing back up, and that may be adding to some of the headwinds for stocks. After coming all the way down, has now shown some pretty decent gains over the last few weeks. Bonds getting close to a golden cross here, but bonds are now starting to show weakness as interest rates go back up. Here is a daily chart showing how rates were coming down, but now they're starting to go back up overall. Here's the MOVE index, which is the VIX for bonds, shows how volatility has really been picking up as bond prices have been going down. Here's a weekly chart showing how the US, UK, and German rates have been going back up. Japan is its own little story, but we're keeping a close eye on that. Looking at our intermarket analysis chart, we're still up when you look at oil, the dollar. Gold has now dropped over negative if you go back to the beginning of 2022, where bonds and stocks continue to be negative. The bonds to S&P ratio shows that bonds continue to underperform. And this also shows that with the stock to bond ratio looking at a monthly chart where stocks have really outperformed bonds. Gold had been outperforming the dollar, but now with the dollar going up and gold going down, we're seeing this ratio turn back down. Gold in the S&P still in an overall uptrend. It came right down to this red moving average. Will it find some support at that level? The low volatility stocks to the S&P are still in an overall uptrend. When we're looking at growth versus value on a weekly chart, it shows that growth is underperforming value. The NASDAQ 100 continues to underperform the S&P. The S&P 100 continues to underperform the S&P 500. Discretionary continues to underperform staples. Energy continues to outperform tech. And then looking back, this is the positive backdrop that I talk about sometimes in the videos. If you go all the way back to the October low, where we set this extreme negative reading, we've been bouncing up out of that. And a lot of times that marks a significant low in the S&P, even though this is calculated based on the NYSE. Looking at 1 to 2 to 3 years, it has a perfect track record. It doesn't mean that we're going to go straight up. We might have some real bumps along the way, but if you're a much longer term investor, you are still hanging on to this scenario. And so far, this hasn't come into doubt, even with recent weakness. What's our outlook for the upcoming week? On Monday, we have durable goods coming out, followed by pending home sales. Then on Tuesday, we have the advanced international trading goods, the advanced retail inventories, and the advanced wholesale inventories. Not really big as far as a market mover. The FHA housing price index, the S&P Case-Shiller home price index, the Chicago PMI, which can be influential, and consumer confidence, which can also be influential. Then on Wednesday, we have the weekly mortgage applications index, the IHS market manufacturing PMI, the final reading. That's not really a big one. This is the big one, the ISM manufacturing index. Construction spending will also be coming out. Then on Thursday, we have every week, we have jobless claims, productivity, the revised version, and the unit labor costs, which will also be revised. Then on Friday, we have the IHS Market Services PMI, the final reading. And here's another big one, the ISM Non-Manufacturing Index. Technicals are looking a lot weaker than they were a week ago, and especially if you look back 2 weeks, because of this inflation and interest rate scenario. We're still positive overall, but we need to see some real buying come into the daily charts to help prop up the weekly charts, and we're just not seeing that yet. We're in an overall downtrend on the daily charts. Looking at the statistics for Monday, February 27th, not anything really all that spectacular. The Dow is neutral to negative, the S&P is neutral to negative, and the NASDAQ is also neutral to negative. So we could go either way with that. Then we do have some speeches coming out in the upcoming week, and I'll just go through and show these. I won't actually explain them to you because none of these include Chairperson Powell. That's the most important person to listen to. These other Fed governors can say what they want, but it's ultimately what does Chairperson Powell say. Our scenarios for Monday, not really going with the down one because we're not in a trending environment. We can't go with the up scenario because we're looking very negative on our daily charts. So we're going with the sideways trend because our ADX is weakening both on the daily and weekly chart. We're below 20 on both. We're still positive on the weekly chart, but we've crossed over negative on the daily chart. Thank you. I hope you found this helpful. I will also be preparing the intermarket analysis video update, as well as the deep dive video where I go through the charts that I didn't really cover in any of the videos this week. And then I will also have the supplemental video where I go through the Isabel Net charts. So I will talk to you in the next video.